Hey, what's up, Gig World? Chuck Driver here. Since you are watching this video, I'm going to assume that you are a gig worker and spend a lot of time on the road like myself, plugging away at the miles, driving for platforms such as Uber, Lyft, Amazon Flex, DoorDash, etc. And you have probably asked yourself, what vehicle expenses can you claim on your taxes? And in this video, I will answer that question by explaining the difference between actual expenses and the standard mile deduction rate. But first, a disclaimer, I am not a tax accountant. This video is only intended for informational purposes and a guide to help organize your 2022 taxes. Please seek a professional tax accountant for specific advice. Now back to the video. So, if you use the actual vehicle expense method, you are allowed to deduct the following: gas, oil changes, tires, all maintenance and repairs, vehicle licenses and insurances, vehicle rent or lease, and vehicle depreciation. Or if you use the standard mileage rate method, you are only allowed to deduct the 2022 mileage rate, which is 58.5 cents per mile from January 1st, 2022 through June 30th, 2022, and 62.5 cents from July 1st through December 31st, 2022. And none of the prior mentioned deductions under the actual expense method are allowed when using the standard mileage rate method. When using the actual expense method, think higher price, lower miles driven. You will get more bang for your buck here if you purchase and lease a new vehicle that you plan on driving sparingly for rideshare or delivery gig work. Compared to and versus the standard mileage rate method, think lower costs, higher miles driven. If you drive full-time for rideshare or the gig economy, you will get a way better tax deduction purchasing a gently used, inexpensive vehicle. So, which method should you choose? Let's go through some scenarios to help you answer that question for yourself. Scenario number 1, using the actual expense method. In this scenario, you drive very little personal miles outside of using this vehicle primarily for gig work, since you have a secondary vehicle registered for your personal use. So, you have decided to purchase or lease a brand new expensive vehicle for $750 a month for majority business use. You have $3,000 annually for your car insurance, $2,500 annually fuel cost, $400 annually in oil changes, and only $300 in yearly maintenance because it's a newer vehicle and maintenance costs are usually lower with newer vehicles, and $120 in new vehicle registration fees. That's $15,320 in actual costs that you can deduct based on the actual expense method. Now, based on this scenario, you would have to drive more than approximately 25,500 business miles to get the same deduction using the standard mileage rate method. And since this is a brand new car that's either purchased or leased, I would not suggest putting those types of miles on it. That would just be stupid. That's why I say higher cost, lower miles driven when choosing this method. Scenario number 2. Using the standard mileage rate method. You drive a lot and you are practically all over the place, working just one or multiple gig jobs, hundreds of business miles per day, thousands of miles per month, and approximately 45 to 50,000 miles per year. You purchased a used, inexpensive car because you are smart and understand that putting high mileage on vehicles depreciates their value very quickly. So, your used car payment is $375 per month, $1,200 annually for maintenance, like tires, brakes, and rotors, $5,750 annually for fuel costs, $900 annually for oil changes, $3,000 annually for car insurance, and $120 in vehicle registrations, fees, and taxes, for a grand total of $15,470 of annual expenses. However, since you drove approximately 45,000 miles this past year and are using the standard mileage deduction rate, your actual deduction using this scenario is $27,225, and yet you only spent $15,470. That is almost a $12,000 difference. That's why you get a way better deduction using this scenario, especially if you are driving a used, inexpensive car that's low maintenance. Like I had said earlier, think higher mileage, lower cost when choosing this method. Other additional tax write-offs for gig workers are a cell phone purchase and its data plan, music subscriptions like SiriusXM satellite radio, Spotify, and Apple Music, car washes, cleaning supplies, vehicle tint, AAA roadside assistance, car chargers and phone cases, high-vis clothing and boots. Remember that it's only considered a tax write-off if the purchase is for business use or a customer's convenience. However, like I said in the beginning, always check with your tax accountant first before using these methods or additional write-offs, as these scenarios may not fit your needs and tax laws can change at any time. Thank you for watching, and please subscribe to my channel if you enjoyed this video. And check out this next video right here on other tax write-offs for gig workers.